Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. Now, my guest today says the outcome of the American economy is already a foregone conclusion, regardless of who wins the next election. The good news is that if you get started today, you may have a couple years still to get your house in order. His name is David Hunter. I've had him on the show before. He is the contrarian macro strategist with nearly 50 years on Wall Street. Now, if you think like Dave and myself and are investing in the commodity sector in order to hedge yourself against an uncertain global economy, then you should check out the Commodity University. I've been a commodity investor for 15 years, and we assembled a 10-chapter video course for anybody looking to begin building a commodity investment portfolio. Go to thecommodityuniversity.com for more. Now, here is David Hunter. Enjoy.
This is Jay Martin.
All right, I'm back with David Hunter. David, it's great to have you back on the program again. I'm looking forward to this. Thank you.
Yeah, good to see you, Jay.
Good to see you. So lots to catch up on. Actually, there's a handful of different directions I want to go today, but let's start just with your macro thesis, because you've been quite consistent since the first time you were on my show, probably 18, 24 months ago. And, you know, this is essentially a melt up before the big crash, the end of the 42-year secular bull markets and equities. Any surprises since the last time? I mean, maybe the last month, right? Things going as expected for you? Any surprises? Any reason to change your thesis at this point?
I don't think so. If anything, I think things are coming my way. You know, the trader type investor gets nervous every time this thing pauses, and you know, you've got to go through those consolidations to build the wall worry and allow for fuel to build up the fuel for further advances. So I don't see anything out of the ordinary in terms of any pauses we've seen. Certainly we had that pause back in March, April that had a lot of people turn much more negative. And then we've gone on to new highs, and we've had a short pause here. I wouldn't be surprised, given what we're seeing in the NASDAQ and the tech side, and particularly semiconductors. I wouldn't be surprised if we've got a little bit more to go here. Might be 3 or 4% in the NASDAQ, and maybe 1 to 3% in the S&P and the Dow, and maybe even less than that in the Russell. I think the Russell's looking like it's almost done with its consolidation, and it's certainly lagged the market. So I'm expecting, once we get through June, the summer to be a strong summer for the markets. And I still have a 7,000 target. I changed my target back in January from a 6,000 to 7,000 range, and just dropped the bottom of the range and said we're going to 7,000. And I've said, I think if anything, I'm too conservative.
Yeah, that's fascinating. Okay, so I got to ask you, has the consolidation of value surprised you at all? And when we talk about the market, it's almost like we're really just down to 5 companies that are driving this right now. And, the NVIDIA valuation drives some people crazy. They can't understand it. There's a lot behind evaluation of a public company, mainly sentiment, but also they control about 80% of the world's AI-based semiconductors. There's maybe a case there for that valuation if you believe wholeheartedly in the AI boom. But what's your take on that?
Yeah, certainly NVIDIA and, the so-called Mag 7 earlier in the year were strong performers. But I have always pushed back on the narrative that that's what's, the entire market. I think I heard this week that there's something like 125 out of the 500 S&P stocks are outperforming the S&P. So, and if you look at, industrials, you look at some of the, home builders, for example, you've had several groups that have performed magnificently. Look at Costco. I mean, for heaven's sakes, on a stock, it looks like NVIDIA. So, there's been a lot more than the Mag 7. People get into these narratives, and, they're partially true, but there's a lot of falsehoods behind them as well. So it's been a narrow, I'm not questioning, it's been a narrow advance compared to what a healthy market should be. But I think it's about to broaden out. What I see going forward is that you're going to see a much broader market, with the Russell probably outperforming all the other three major averages into the top. My target on the Russell is 3,300. So from here, you're talking about 65% advance, with maybe the Nasdaq and the S&P having half of that or less. So I think you are going to see a much broader rally into the top. It's been slow coming, but I still think that's going to happen. That does not mean Nvidia is done, or that the tech rally is done, or semiconductors are done. I think they will continue to participate and maybe even lead into the top, but there's going to be a much broader leadership, I think.
Right. Now, how do you play that personally, David? Do you have skin in the game in that rally, or are you backed off on the sidelines looking for other opportunities?
Yeah, I definitely. I mean, I don't talk about my own trading at all, because I got to be careful it doesn't get interpreted as some sort of advice. But I will say I certainly have skin in the game. I put my money where my mouth is, and I do believe there's, as I keep saying, it's a very unique period where I'm talking about 30 to 60% upside in the market, and yet saying that could all happen this year. And so you're coming to the end of a 42-year secular bull market. And so normally I'd be saying, don't be so cute that you think you can call the top and get out right at the top, because that's not reality typically for most investors. On the other hand, there's such a long runway from here to the top in terms of the magnitude of the rally, that I think you don't want to jump out too soon, because you're probably going to be forced back in. If you get out early here, and then all of a sudden see the Russell has more than 50% upside, and it's going gangbusters, you're going to change your narrative and say, hey, there's a lot more to run. You may even think it's got years to run. I don't believe it does, but I think the magnitude of the rally is what you would normally get in a matter of 2 or 3 years.
Right. Okay. I got to ask you what you expect from a Fed policy standpoint, over maybe that same time frame, next 2 quarters or 3 quarters, especially with an election coming up. Any thoughts on that?
Yeah, I don't think they're election driven. I mean, I'm certainly aware that Yellen's probably talking to Powell and saying you could, it'd be nice if you could help us out a little bit. But I think Powell is a straight shooter, and I think the FOMC are basically, their members are basically trying to be as non-political as possible. What I believe is that we went through the first quarter where it looked like inflation might be pushing back up, and that we might have gotten all we're going to get for a while in terms of the bringing inflation down. And what we've seen in the last month or two is it going the other way, and maybe it looked more like January in particular was an aberration, or just kind of a stair-step backwards. I believe going forward, inflation is going to be good news, not bad news, that we are moving further down. I think the consumer is showing signs of deceleration. So I think the economy is decelerating. Inflation's likely to decelerate from here through the balance of this year. And that means I think the Fed's going to come the other way again and say, maybe we can do rate cuts. So I would not be shocked to see a rate cut at the July meeting, which I think is the end of July. And if not, then certainly in the September meeting. So I'm of the belief we'll see 2 or 3 cuts this year. And if things really decelerate, you could see more than that. But my guess is it's limited somewhat, because I also have this bullish view on where the indexes are going. If Powell looks and sees the S&P anywhere near 7,000, I just don't think he's going to be in a mood to cut further. So you might get the first cut and stop, or you might get 2 cuts and stop. I don't think he's going to feel compelled, even if the economy is decelerating, if the market's that high, to say, hey, we need to give it more. So, Bill Dudley's thesis of back in spring of 2022, when he talked about financial conditions are very much influenced by the stock market, and how, at that time he was talking about the stock market having to, be pushed a lot lower. Powell bought into that. Now he's since then seemingly ignored the market to some extent, but I think it's still in the back of his mind that, yes, stock market being healthy is okay, but if it's running away, maybe that's inflationary, and maybe we have to counter that. So I don't think it's going to be clear sailing in terms of rate cuts, but I do think you could get a couple of them here.
Interesting. So at a high level, economy decelerating, so economic activity down, inflation trending down on the heels of that, rates possibly cut on the heels of that, simultaneously this decoupling where the markets continue to run. And that may be the check that Powell starts to look at and says, despite depressed economic activity and maybe inflation is looking a bit calmer, the market's ripping and we need to be on top of this. Yeah.
Yes, that's true. And what I have said consistently is, although I think the Fed could cut here, my thesis doesn't depend on that because the bond market's going to take rates down either way. So, whether the Fed cuts or not, it's really the bond market that's going to determine rates, as it always does. And I think rates are going lower. I think we're going to see a sub 3%, and I think actually a 2.5% 10-year this year.
Okay. Could I make the assumption then that prediction for energy prices is also down?
Yeah, that's definitely been my thesis, is that we're heading towards 60 on oil. We got down into the low 70s or maybe into the high 60s, and it turned around here. And now all of a sudden you got the voices coming back saying, hey, we're going back towards 100 or back over 90. I don't think so. Anything's possible, but I think more likely this is just one of those stair steps counter trend rallies. And I still think oil rolls over here and heads lower, partly because I think the global economy is softening.
Right. Okay. And then how would you place an asset like gold into this thesis? Again, that same time frame. I think longer term, you're very bullish on gold, but inside of the next 6 months, markets up, economy down, inflation down, rates possibly cut, oil down. Thoughts on gold hitting and staying relatively near all-time highs right now?
Yeah, believe it or not, I'm very bullish gold near term. I mean, I think you can see 3,000 has been my target for a long time, but I think we can see 3,000 this year. I think you can see 60 on silver, and I've said if it gets to 60, it may push through and go to 75. So those are big runs, and I think what we've had in the last month or 5 or 6 weeks of consolidation, I think is setting us up very soon for a big rally. And so I think we have a strong summer in the metals. The miners, which have lagged, I think will finally start catching up too.
Yeah, my audience, they love hearing that, David. As you probably know, I'm quite exposed to the miners, and I feel like timing's great because I have a long time horizon. I don't really sweat, what may happen this quarter or next quarter. And similar to you, when you said you don't like to expose your individual positions because people take that as advice, I've learned that when I talk about a company I've invested in, often, people assume, oh, that means Jay thinks this company's going to rip this quarter or next. It's like, no, that's not. I just think it's cheap. That's all that means, is that I think it's very cheap and everybody hates it. And if it takes
you have to kind of as I say, for people, and so many new investors come in and they treat investing like gambling. And I go, buying low and selling high doesn't mean it has to happen in the next 3 months,
Exactly. Yeah. You can sit in a position for years before you get that action. And which really comes into the strategy behind it all. I mean, at the beginning of this, you were just talking about like the trader type mentality, looking at the short-term fluctuations in the equities markets and making grand assumptions about what those short-term fluctuations may mean, when in reality, it's just that nothing goes up or down in a straight line. There's volatility in both directions, but you want to look at the bigger trend. Yeah.
Yep. And as I say to my followers a lot of times, the market loves you guys. It loves to take people who fall for those moves and draw a big conclusion from them. That's exactly what those consolidations are for. They're there to make you nervous, to build that wall of worry back. And if you react to it, you're basically playing right into the market's hands.
Yeah, I completely agree. It's why it's so key to know your time horizon, because if you're clear, you're in a position and you can be there for 5 years, then what does it matter what happens this quarter? Or if the value you intend on realizing is 3 years away based on the company's, business plan or what they're doing, then why let short-term volatility shake you out? Because the price of something tomorrow shouldn't affect your thesis a year down the road.
Having done, having done this for 50 years, I can say, the longer I'm in it, or the more recent times, so many investors are not investors, they're traders. I mean, I don't know what the mindset change was. Maybe it's computers and having all kinds of programs that you can look at on a short-term basis. But I find so many retail people who have no idea what they're doing think everything's supposed to happen fast.
Yeah. Well, it's the difference between trading share prices and understanding that you're actually taking a fractional ownership in a business, right?
Yep.
And as a buddy says, the share price is just most of the time a floating abstraction, right? If you don't understand the value of the business you're investing in, then what does the share price matter? Because you don't understand the context and the difference, and therefore the opportunity. Okay, I want to pull on the gold thread for a minute, because I talk to a lot of people in this business. I try to interview gold bears. My audience would probably say I don't do that enough, but I do intend and try. What's your take on the price action of the gold sector right now? Because if you look at the rest of your thesis, you could make the assumption that it's weird for the lifeboat, the insurance asset, to be getting any love right now if there's so much opportunity in the equities market. So I'd love you to expand on that for me.
Sure. Yeah, I really believe, and it hasn't come to fruition yet, but I really believe we're staring at a very weak dollar ahead. It's hung up, it's hung in here. It started to break, I don't know when that was, a year ago, and then turned around and had this very long counter-trend rally where it's gone up, come down some, and gone up again. I really think we have a weak dollar ahead. The problem is Japan's been stubborn in terms of changing their policy, but I think it's a matter of time for them. I mean, they're defying logic in terms of printing money like crazy and being able to keep interest rates close to zero. That's just not. We saw what happened here in 2022. When it breaks fast, and I think Japan's very close to a reversal in the yen. So not by choice, but I think rates are going to start pushing up there. My read of the euro is that the euro is going to rally. Canadian dollar, Australian dollar look poised for rally. So I think the dollar is going to come under pressure. Part of it is going to be, I think, that our interest rates come down faster than some other places. Whether it's Fed induced or whether it's just our economy is going to start decelerating pretty fast, I'm not sure yet. But I think that's all playing into, weak dollar obviously will help gold quite a bit. Lower interest rates, I think, may seem somewhat opposite to intuition, but I think lower rates helps gold. So I think you got both of those coming here. And at the same time, you still do have plenty of things around the world to get those that want to look at gold as a safety or a place to run. You got the geopolitics out there that is going to add to that. You've got central banks, particularly China and Russia, buying up gold, looking to back their currencies perhaps. So you've got I think there are a lot of cross currents out there that are going to help gold, but more than anything else, technically, gold broke out, as got above that 4 tries at 2100 or wherever it was, broke out and had a nice run, and then has consolidated for a couple months at a high level. And I think it's ready to break out again, or get out of that consolidation. I think the next run is probably going to be right to 3,000. So I think both technically and fundamentally, it's got support here. And there's been in both gold and silver, you've had very little institutional sponsorship. And if they start performing here, they're pretty thin markets, or not very big markets, particularly on the minor side. That if institutions decide they need to have 5% of that in their portfolio, and they start copying one another, it doesn't take much to drive these prices up.
No, it doesn't. So then extrapolating that into your silver thesis, you mentioned possible $60 silver. Do you think, is that just kind of the shoulder bet on gold? Is that the poor man's gold bet, or are there other reasons for? Yeah, okay.
Yeah, I think certainly poor man's gold is a big part of it, but it also is a metal that's in strong demand and not very good supply. And as you know, I mean, it's not an easy, neither gold or silver is easy to find anymore. So, once you start seeing that tight supply demand situation, it's a long process before you can get that supply worked out. So, I think it's got both fundamentals going for it and just the fact that it is poor man's gold.
Okay. Okay. Now, quick question on the dollar there, just to back up a minute. Were you surprised when Saudi Arabia decided not to renew the Petrodollar Agreement? Were you surprised that it didn't get more media attention than it did? Do you think it's a significant event, or is it more of an abstraction because they could already sell oil in other currencies should they want to?
I'm not all that close to it. What I have seen was that it's not even a sure thing. I assumed it was a sure thing, and then I saw some commentary where that's what Russia's been reporting, but that it hasn't been confirmed. So I'm not even sure that it's actually taken place. You may know better than I do that because I'm not that close to it. But my thing is, I guess I'm not overly surprised because the Biden administration has not had good relations with the Saudis and certainly has not shown any inclination to help their problems. And Saudi's been talking about getting closer to China and doing things in other currencies. So not totally surprised. I'm a little surprised in that we were such a backer militarily to them, and and certainly under Trump, the Abraham Accords and everything, there was a good relationship with the Saudis. So I guess my attitude would be if Trump gets back into office, I think that relationship can be repaired. I don't think it's a sign that's long-term broken, but the Saudis may be just saying right now, you guys aren't doing us any favors.
Yeah, you mentioned that, and I want to pull on that thread a little bit because I feel like, David, for most of my life, my assumption about the president of the United States has been that they're far less significant than we might believe. That the big macro trends are already in play and their ability to impact significant change inside of really 2-year election cycles is not much, right? There's a lot of resistance, and you're constantly playing the voter game but maybe that hasn't been the case for like the last 6 years, and maybe it won't be for the next few. I feel like the leader of the free world has had a much bigger impact on the direction of geopolitical relationships and the consequences of those relationships going certain directions. I interview a lot of geopolitical analysts on this show, and often I hear that the next U.S. election may end up being the most consequential geopolitical event of the decade. And that's kind of where we're at this moment in history. Would you see it that way? And what's your take?
Yeah, 100%. I said that my call for a global bust doesn't matter who wins the presidency. So I think the seeds are already sown for that. But in terms of our way forward, I think we are out in the States, and I think it's somewhat parallel up in your neck of the woods. We're at a very big crossroads where, I'm big on saying, I don't hide it. I believe that most of the establishment in this country, the establishment politicians, have gotten in bed with this New World Order agenda. I don't quite understand why those on the right would do so, but, we're really seeing an election of populism versus the establishment is what we're seeing. It's not so much Republican against Democrat, because a lot of the Republicans have not helped Trump at all. So I think they're all fearful that he's going to come in and break up their party. And I don't mean political party, but their party in Washington and their game they've had for decades of basically raping all of us, and at the same time, you see what's going on with Klaus Schwab and all that's going on in Europe and elsewhere. There's this New World Order idea of kind of taking away sovereignty of these countries and moving to a one world government, Trump's basically in this country the only thing standing in between that. I think the skids are greased in terms of going in that direction. Certainly, I believe Barack Obama is basically running the Biden administration. This is just a third term of Barack Obama. And I think that's, it probably started before him with the Clintons, but that's really what we're seeing is the left pushing an agenda to move us further and further away from, a sovereign capitalistic republic, and more towards, whether it's one world government or more socialism, et cetera. And I think if Trump doesn't win this election, we may not see in this country two parties for much longer. I mean, or anything but the same party keep winning. They've got things pretty well nailed down. Some of it legal and some of it not. But
Right.
so I do think this presidency, it really does matter. Certainly, when you look back over the years, there's that belief that big banks basically ran the world, that, who you put up for president was kind of just a figurehead, and that it was really what the big bankers wanted. And that's probably still to some extent, but boy, the stakes are high. I think there's a huge difference between a Donald Trump as president and a Joe Biden as president.
Yeah. Now, in an environment where trust has plummeted so much in any media narratives and anything politicians are saying, what really surprised me was that the presidential election coming up, it's not going to be live, correct? And there will be no live audience, which is
I'm not sure what you mean. You mean in terms of mail-in voting and?
No, the debate between Biden and Trump.
Okay, yeah.
And I just felt that in today's lack of trust environment, to then pull another filter over the election debate and just add a layer of distance between the voters and the actual conversation was such an odd decision. And it shocked me that nothing's been said about it. This is the two candidates competing for the leadership of the U.S. and the way to present the debate for the first time ever that I've seen is through this new filter. We're going to watch it. What's going to happen? There's not going to be a live audience for the first time ever, and there's going to be the opportunity to edit it before you see it for the first time ever. Struck me as very, very odd.
Yeah, I'm not sure that it's subject to edit. It's supposed to be a live debate.
It's supposed to be. Okay, I'm speculating a bit. Yeah. I'm extrapolating on this. I'm just saying, if you're not letting the live audience in, then why would I trust you that I'm seeing it live? Like, if it's live, then let it be live. Not have to be live.
I hope we haven't gone that far. I think it is going to be live. I hope, maybe there's a time delay or something, but my guess is it's going to be live, and you've got Donald Trump in the room. I don't think he'll be silent if it isn't. Whether the other side pushes back and said he's just making that up, that's all possible, I guess. But I think the odds are it's a live debate. The problem is there's no audience, and I'm really surprised that Trump agreed to that. I think he must. My only thought is he agreed to basically CNN and ABC doing the two debates, and they're both, again, it's amazing that we can say this today without any question. I don't think it's debatable anymore. They're just basically, the vocal arms of the Democrat Party. There's no, they don't make any qualms about the bias they have anymore. They may think they're fooling people, but most people see through it now, and it's, the biases are there. So, and the moderators this time around, and Jake Tapper's, openly, vocally said he can't stand Donald Trump. So, Donald Trump agreed to these things. My only guess is that he felt so strongly that, Joe Biden isn't going to be able to debate given his faculties, that he said, I'll agree to anything because, whatever the terms are, I can beat him. I think it was a little bit reckless to do that, but I guess time will tell.
Yeah, and the only so I am speculating and making some assumptions there, I suppose, when I say it's not live or there'll be the chance to edit. It's just because they've eliminated the live audience. And I'm just like, so you're going to take all the witnesses out of the room and then just tell us, don't worry, it's the same. Like, okay. And my only hope is that both candidates have their own camera crews in the room and are recording the raw footage for.
Yeah, I think the audience, the agreement on the audience had more to do with the realization that Trump's audience would be very vocal in there, and that I think somewhere along the line when he was debating Hillary, he brought in witnesses to Bill's infidelities or something Bill did, and so I think they don't want that kind of Trump to be able to bring in an audience that can kind of show some truths about Joe Biden. So it may be that I really, and more than that, I think they just know Trump's a far more popular politician than Biden. So I think they're definitely trying to slant the field. I think the playing field, but I'll be shocked. I mean, they've done a lot of things in terms of what they've done with the elections and cheating, etc. So I won't put anything past them, but I'd be shocked if they can get away with basically having a debate that is not live.
I mean, could I press on this a bit more and just say, did we just watch the politicization of the justice system? Like, did that just happen?
We sure did.
We sure did, yeah. And I mean, is that the first time the justice system has been weaponized to that effect, to serve political means, to that extent?
Yeah, I mean, there's no question. That's why I say the stakes are huge this election, that this is basically the last chance to save the republic, in my opinion, as hyperbolic as that may sound. I think this thing is moving so fast and so far. Again, this isn't something that just came out of nowhere, and that Joe Biden is the first, is the crafter of this. This has been in the works for decades. It's just in the last couple elections, and particularly the last one, they've become blatantly. They're not afraid to hide it anymore. What they're doing, you get the sense that they, meaning the left, feels like they've already won. I mean, they are. A lot of the subtleties you used to see, you don't see anymore. They're right out in the open about it.
Yeah, I mean that's what Hillary Clinton thought in 2016, that it was a shoo-in. It's interesting to watch. So then, we've spoken a lot about the, I guess, the financial health of domestic United States, the culture, the politics, the future of the republic, in your words there. When you zoom out, though, David, and look at a global, take a global perspective and think about just the cycle of empire and where we might be in this present day American world order relative to the British world order and the Dutch world order and the Spanish of the past. It's really easy to make a case that we're in the late innings, right? You can just sort of paint that picture with relative ease. I don't buy into it so much, to be honest with you, because I think it's a pretty big question and a tough one to answer. But when you look at the financial instability inside the United States, the internal conflicts, the external competitors rising up and trying to find optionality outside of the U.S. dollar. What's your take on the grander cycle of empire?
Yeah, I'll take it from two different directions, or two different angles. One is I believe we are in the late stages of a super cycle, and I define a super cycle as that period between that long cycle between two depressions. And so from an economic standpoint, and politics kind of goes along with it, or society goes along with it. Basically, we've been at this cycle since the Great Depression, or since after the Great Depression, and I think the next depression is the 2030s. As much as I'm calling for a global bust next year, which I think is something maybe more dramatic than 2008-9, I still don't believe it's a depression. I think it's fairly fast, like 2008-9. So I think the real collapse comes in the 2030s. So you're basically in the last decade of a super cycle. And I think government-wise or politically, I think we're seeing it kind of parallels that. And then you look at the reason you get to the end of a super cycle is the excesses. And we've built debt up both in the U.S. and throughout the world to levels that are not sustainable. And what has kept me consistent in my view is that the equation that you come up with does not balance. You can't, I can see the seeds are sown. I can see the things that are leading to a period of time where we've got this massive debt that we cannot play the game anymore. In other words, you have the bust, and I say the stock market could go down 80% in the bust, but the bust is actually the economic and the financial system goes down hard. You get, some major bank failures around the world, similar to 2008-9, except this time I think it goes deeper and steeper. In that bust, the easiest prediction I can make is what the central banks are going to do. They will come out with all guns firing because they have no choice. They either don't do that and watch the system implode now, meaning next year maybe, or they do that and postpone the inevitable for another cycle. And if given the choice between saving the system or watching it and saying, "Oh, we don't want to cause more inflation. We don't want to do that again," that's not in their nature. I mean, if they are looking at an imploding system, they're going to come in with all guns firing, and that means printing money like never before. So I've been on record saying I believe we'll see something like 20 trillion in new QE out of the Fed, and proportionally similar around the world. Every central bank printing like crazy. That saves the system here. They'll do all the fiscal things they have to do to go along with that. You save the banking system, save the financial system, and with a lag, turn the economy back up, and you'll have another cycle. The problem is we're so close to this inflation breakout we've had. You might get a year or two reprieve because I think that bust could cause short-term deflation. But within a year or two, you'll be right back into what we're in 2022, inflation moving up and moving up a lot faster and steeper. So that by the end of the decade, you're looking at, I say maybe even 25% inflation in this country, and interest rates, between 15 and 20% or higher. Short-term rates maybe even higher than that. There's no equation where the government can service their debt when you have that cost of servicing. So it brings the cycle to an end very quickly, whether that end is 2029 or 2031. It's somewhere in that period, I think, where the music stops, the game's over, the Ponzi scheme that's been in place for decades comes to an end. I mean, nobody's going to want our debt, and I'm just looking from the U.S. standpoint, but it's not just the U.S., it's Canada, it's around the world. Nobody's going to want to buy debt. You're not going to be able to do QE. You're not going to be able to monetize the debt because nobody's going to want it. And you're not going to be able to print money to monetize the debt because more money when you're in a hyperinflationary environment just turns into Weimar Republic very quickly. So, so in other words, you lose the printing press. The printing press is the only thing that's really allowed us to keep this going for the last 30 years. Without a printing press, our standard of living was declining. Without the government expansion we've had this last 30 years and monetizing that debt that financed that government spending, it would have been a reality long ago that we were in the later stages of our, this great experiment we've had, democracy or a republic or, America. But we've been able to kick the can down the road many cycles because, you had feast and then you'd have famine, and it would cleanse the system enough that they could print money again and do it again. You're coming to the end of that. I mean, all of a sudden the cycles get much shorter. The inflation comes back much faster. The amount of money it takes to save the system becomes so much bigger. And that just leads to even more excesses. All of a sudden, you just reach the point where you can't do it anymore, even if you wanted to. So, I'm pretty sure we're in that. Whether it's as I say, the difference between myself and a lot of the Austrians out there that the Peter Schiffs of the world that want to say we're coming to an end now is that because I think inflation is going to be, we'll either have almost zero inflation or deflation next year. That gives them almost infinite ability to print money. It gives them one more kick the can down the road moment. But after that, I think you've lost that ability, and then it comes to an end. So the parallel to that is what happens government-wise, militarily, etc. I can't predict it, but I think it goes in parallel. The odds are, by the 2030s, world war is probably an inevitability or pretty close to it. At the very least, I think we get a collapse of the financial system we've known for all these decades. So it's, what comes out of the ashes of that, the vacuum of that. Is it going to be totalitarianism or is it going to be a fresh start? I don't know. But to get there is going to be a very tough ride. I say, and I obviously have no way of knowing, this is seat of the pants, but I can imagine a period in the 2030s, and I don't know whether it's 2032 or 2035 or when, but a period in there where the collapse happens. We've got, in this country, no Social Security or very limited Social Security, no Medicare, no Medicaid, no welfare benefits, no unemployment benefits, and a 50% unemployment rate at least. That's dire. People are assuming always that the system will bail them out. If we get into trouble, there's always, the government to bail us out. If you don't have a government or they don't have the funds, that's gone. So you have no support system, and then it's everybody for themselves, and that's not going to be a pretty picture.
Now, yeah, so it sounds sensational. It also sounds very pragmatic when you look at the financial health of the United States and the I guess the sustainability of the dollar. The debt issue is something else. It's hard to just wrap your mind around $34 trillion of debt. It's just a number that doesn't really exist in a weird way.
And I throw out the term 320 trillion globally. I mean,
sure.
There's both sovereign debt and government. There's both the sovereign debt and the private debt. And all the promises that government makes beyond the debt. So it's a big number that nobody can wrap their head around.
No, because it bleeds into fiction, I guess. And $2+ trillion annual deficit. Well, Trump has come out and said this solution is decreased taxes and decreased regulation. And he feels like there is an opportunity for the United States to grow their way out of this trouble by removing barriers to for entrepreneurs and for businesses through decreased regulation and taxes. Is there anything of substance there? Is there enough there, do you think, that could the United States grow their way back to, I don't know what, or are we too far down the path?
Yeah, if I'm wrong, I'm probably wrong because what I am calling a global bust is something much less than that. We are able to have a recession, not just a soft landing, a recession, but it doesn't turn into a crisis like we had in 2008-9, and it doesn't. What I keep saying is we've got that 320 trillion in debt, and we've got quadrillions in notional value of derivatives, which is leverage on markets or leverage on securities. Those are two forms of leverage, debt and derivatives, that are at levels that are way beyond anything we've ever seen before, even way beyond 2008-9. If we get a slowdown that turns into a recession, my assumption is what that leverage does is it really breaks things. It exacerbates whatever it is. That's why I'm calling for a bust, is that if for some, in some way we're able to skate through that and have a more normalized recession, then I think Trump's policies are obviously very much more what we want to see. I think you can lower taxes, control regulation, and all of a sudden economies can be efficient again, and you can generate a lot higher GDP, et cetera. So that would be the hopeful side of it. I think it's a low probability, and it's not because I think Trump's wrong. It's because I think the bust happens no matter who's president in their first year, and I don't. Neither one's going to have any ability to control that. It basically, we got to save the system. Here's what you got to do. And once you get into that massive ramp up in both money, monetary expansion, and fiscal expansion to save the system or to bail the bust out, it becomes not 34 trillion in debt, but probably double that. Because if I'm talking, or almost double that, if I'm talking about 20 trillion in money, you'll see a similar amount of new debt coming out because they'll be coming up with any program they can to kind of goose the system. So it's, we're at, let's say, 320 now in global debt. I suspect by the time we get to the end of the decade, most of it happening in the first part of the next cycle or in the bust and the year after, I think you could see global debt up closer to 450 or 500 trillion. So if 320 is off the rails, what's 500? And again, it'll then have to be serviced at rates that are, because I think next year you could see a 0% 10-year because of the monetization of the debt. They'll be buying up every bond they can. So you could have for a little while, they'll be thinking, well, we can service this because rates are low. We'll keep rates low. Once inflation ramps up, it's going to ramp up very fast. All of a sudden, like I said, you're going to be looking at 15 and 20%, not only T-bills, but long bonds. And there's just nothing they can do to service debt. And the debt's going to be double what it is now. So I just don't know how that equation leads to anything but a disaster.
Yeah. I mean, that does get back to the idea that, one individual cannot change the course of history.
Or his policies are just too little, too late.
Too little. Well, exactly. Too little, too late.
If this were 20 years ago,
maybe
you'd have a real shot at this. But it's
right.
Look what we've done. The 2008-9 led to a much bigger excess. To try to bail that one out, and now we've squandered that opportunity, and we're right back into something that could be far bigger than that.
Yeah. I mean, that's the sort of George Friedman take, is by the time you get to the president's seat, the big decisions have already been made for you 10, 20 years ago, and your ability to shift that. And so that puts us forward into this potentially global conflict scenario, which again is unfortunately consistent with the sunset years of empire. The Spanish handed it to the Dutch at the conclusion of the 30 Years' War, the Dutch to the British at the conclusion of the Fourth Anglo-Dutch War, the British to the United States at the conclusion of World War II, of course. And when you run out of tools to leverage, you turn to the military often, and that's why these cycles end up in war, which decides the new outcome, which is very hard to predict. It's impossible to predict the outcome of
Unfortunately,
war.
though, we have really seen, particularly in this last 4 years, our military's been dumbed down in a big way. They're not supporting it it used to be we had the goal of being able to support two battles at the same times, simultaneously, two big, war fronts. We can't even support one practically. So, and they're doing all the woke things in the military. They're not, they're having trouble recruiting, all of those things. Meanwhile, China's building up. It's hard to know exactly where we're at in that, but it does feel a little bit like the decline and fall of the British Empire, and as you say, before that, it feels like we got fat and happy, and maybe we're at the end of our strength. So,
So walking into that decade, then. I've heard you talk about the shift of focus for investors and moving into a commodity super cycle, right? Commodity has been very unloved for a long time. And partially that's probably because the world's been pretty easy and predictable. And when the supply of things is predictable, you don't value them very highly. But when the supply becomes unpredictable, the value goes way up. And how much of that, the reshuffling of the geopolitical chessboard and the trade alliances and all this, do you contribute to your bullish commodity cycle?
Yeah, I think it's very much, because I think it is going to be worldwide a reindustrialization. I think a lot of countries are saying the supply chain issues that came up in 2020, 2021 and 2, that they don't want to go back down that route, particularly the U.S., but I think other countries have seen that too. And so you're seeing more, that global, that whole, and I grew up in it, the economics during my time in school was the beginning of that whole thing of comparative economics, that you do what you do well, and you farm out the stuff to the lesser developed countries to do the more heavy duty stuff that doesn't take as much skill, etc. Globalization is good type of thing. What we're seeing is pushback on that because it's failing. The supply chain thing was one failure, but there's lots of others in terms of, we don't control our destiny if all our pharmaceuticals are produced in China. We don't control our destiny if all the steel is produced elsewhere, and then we need to ramp up World War II style, and we don't have the facilities. So I think you're going to see a reindustrialization. We're seeing it obviously in semiconductors, et cetera. We're going to see it, I think, in a lot of areas, and are already seeing some of it, such that there's going to be, and again, other countries are going to be doing the same thing. All that heavy industry or capital building requires commodities. And there's going to be a huge ramp up in demand, and the commodities have been sized down over many decades because we had gone more to a service economy, more to a consumer-driven economy that doesn't demand commodities in the same way. And now all of a sudden it's going to go the other way. You just can't build supply up quickly. That takes a decade in many cases, like copper mines or other metals, etc. So I think you're going to see, because of that 20 trillion in the U.S. and probably 100 trillion across the globe of new money, that creates, at the same time they're doing the industrialization, it creates a ramp up in demand very rapidly with no supply to coincide with that. The only thing that can give is price. So you can get some, unbelievable price increase. I mean, I talk about $20,000 gold. Not that gold is a huge industrial metal, but it'll go along with it. Copper, I can begin to know the number, but it's probably tenfold from where it is. So, I do say $500 oil. Natural gas will go through the roof. You'll see, across the board, most industrial commodities and commodities that are going to be demanded by industry are going to be straight up. Probably 2026 or 7 it'll get going, and by 29-30, it'll be unbelievable prices, and that's why I can say 25% inflation.
Yeah, well, there it is. Yeah, that trickles down heavily. Right. So I think you come with a very important message. And if my entire life thus far has been mainly the era of globalization and increased trade leading to a wider variety of cheaper and cheaper goods, and life's been pretty good. I've lived in a colossal bull market, but literally. It might be time to get your house in order. And we don't know what's directly next, but that era might be coming to the end. And if it's not great, still a good idea to get your house in order. But if it is, you want to be ready for whatever's next by just tightening up the loose ends. Yeah.
Yeah. I tell people, they get panicked by my 2030 scenario. And I go, obviously it's a ways off. I could be dead wrong, but it's just putting the pieces together. That's what I see as most likely. But people want to worry about that now. And I go, look, you've got a melt up, a bust, and then a huge commodity cycle ahead of you. Those all create opportunities for you in the way you manage your money, in the way you manage your household. You've got basically between now and the early 2030s to get that house in order financially as well as otherwise. Get your debt down. Make sure you make good decisions on your investments. Don't get talked into, what worked for the last 20 or 30 years of, buy an index and sit on it because they outperform active managers, and you couldn't time the market. No manager timed as well as just sitting and holding an S&P index. going forward, if inflation does what I think, the indexes are going to get punished because what drove the indexes was PE multiples going from 8 or 9 to 20 or 25 as a market multiple. What you're going to have is a reverse of that in the next 5 or 7 or 10 years, where multiples go from 25 back down into single digits. And it's hard to overcome that. Yes, you can have earnings overcome some of it, and that's why commodities will do well, because earnings will outperform the loss of PE multiple, outperform inflation. But the vast majority of stocks, including tech, including consumer stocks that have done so well, they can't keep pace with inflation, and so PE multiples shrink, the market multiple on the index will shrink a lot. So what happens then is, I think, as I've said, this is the reasoning for why I say it, the peak we make this year, I think the top we make in terms of the S&P or the NASDAQ or most of the popular indexes will likely stand for decades. So you'll have a bull market coming out of the bear market. You'll have an 80% down. You could triple or quadruple coming out of the bottom if you go down 80% and still not get anywhere near the highs of this year. So it's not that there won't be opportunities in other things besides commodities in the first couple of years out of the bust, but the commodities are the only thing that are going to be able to sustain it beyond that, because they'll be able to, their pricing power will allow their earnings to outpace inflation.
You give us a lot to think about, David. I really appreciate chatting with you. Okay, well, I thank you for your time today. It's always great having you on. It's always great, and love to do it again in the near term here.
Yeah, it's a little bit of a crazy scenario, but I just think, forewarned is forearmed, I think.
That's it. Exactly. And sometimes these more pessimistic outlooks put people in such a state of frantic fear that they just start reacting irrationally. And this is not a sell everything and hide under a rock forecast. It's not like especially the last 10 minutes here, I found myself thinking, like, what this means is that over the next 10 years, there's likely going to be a couple generational wealth creation opportunities that, we'll see just once in our lifetime, and being in the right place at the right time, keeping a cool head, paying attention, that's when generational wealth can be made.
Yep. And at the same time, don't gamble, don't see this great opportunity and think it's going to all happen in 3 months and buy options. That's not the way it's going to work.
Right. That's not the plan. All right. Look, thanks again, David. I really do appreciate you. And look forward to doing it again.
Okay. Thanks for having me on, Jay.
All right.